High inflation, the stock market going down, a supply chain crisis, interest rate hikes, ongoing conflicts, and the COO of a vegan food company allegedly biting someone's nose. Is now a good time to try and start investing, or are you better off just waiting a bit for all of this to blow over and go and have a coffee? Let's look at our options and decide what to do. Like anything, trying to get started is probably the hardest part because in your head you make up every single reason known to man why you need to wait for the right time. Whether it's going to the gym, doing the washing up, or even making a sales call. Often it's called analysis paralysis, as your brain just keeps listing all of the negative reasons why you shouldn't do something when you know that really you should just need to throw yourself in and get started. With investing, there's a lot at stake because we aren't just talking about going out for a run here or lifting our first set of weights. This is our own hard-earned money that we're about to throw into some weird platform, and we're always thinking of the horror stories where people lose everything the moment they start. Okay, so let's figure this out. At the moment, you're probably looking at the news and you're looking at the stock market and you've seen it drop quite a lot, at least since the start of this year. Even big companies, which you might have thought were the safe ones, have crashed loads. Just look at the overall market. The S&P 500 is down 20% so far since the start of 2022. And then inside of that, the big players like Meta are down more than 50%. Netflix are also down heavily. And there's a ton of other companies like Shopify, Zoom, and loads of others who've had the craziest rides over the past couple of years. And you might have even thought you wished you could bought some of those stocks right at the bottom and right at the top. We could have all been rich. Now, all of that is just wishful thinking because if you weren't invested, you can't go back in time and just cherry pick. Otherwise, we'd all be doing it. The biggest issue you've got when you start is that all you can do is look at previous data on one hand, and then on the other hand, everything looking into the future is just a guess. So at any single point in time, you're either looking back at all-time highs thinking, we could definitely go much lower than now, or you're looking back from a high point thinking, I don't want to miss out, I better get myself in right now. So getting started always feels like a mental battle, either driven by fear of missing out or trying to chase some kind of market bottom and finding a bargain. I remember feeling like this when I first got myself started, and I was really anxious that the stock market was definitely going to have a market crash. Pretty much human nature to expect the worst, especially when you make any major financial decision. We get ourselves really worked up as if we've only got one shot at doing this, like some kind of audition for Britain's Got Talent. And if we don't nail this performance in front of Simon Cowell, we're doomed forever.
What's it called?
In reality, investing is much more like a marathon than a one-time show. Unless you really insist on putting it all into a single performance, when you invest your hard-earned money, you get loads of chances to get in. And as long as you get started at some reasonable time, you should do pretty well. But at the end of the day, nothing's guaranteed. Alright then, let's weigh up the pros and cons of starting right now. Say you've got some money set on the side and you're really keen. Remember, we don't know the future, so all we can really do is try and learn as many lessons as we can from the past, from what's worked and what hasn't, and then also use some of the new tools that we've got available as investors today that previous generations certainly didn't. First things first, let's just assume the absolute worst case event. You invest $5,000 or pounds into the market today, you've pulled the trigger and you want to do this for the long term, and then over the next 6 months the stock market crashes more than 40%. Let's say that all of the stuff in the news comes true. The housing market crashes, inflation takes over, interest rates soar, you name it. It all happens, and now you're looking at your investment app and you see that you've got about 3,000 left. How are you going to feel? And the question is, what are you going to do about it? You're going to be gutted and you're probably going to kick yourself because you knew something bad was going to happen, right? Now, you can either sell it all now and brace for even more falls, or you can wait it out, but you still feel pretty beaten up. The next question, during that 6 months, are you investing more, or are you now waiting for things to get better before you put any more money in? You don't want to lose any more money right now and you're really starting to get worried. So again, what are you going to do? In a real world example, what if, just like before the great financial crash, you did all of this in 2007 as the stock market looked pretty good and was heading up, just before a massive pullback of almost 50%. To get yourself back to level, you would have had to wait for 6 years. 6 whole years of seeing your investment account in the red. I'm honestly not sure if many people could just sit back and ignore that. So again, what do you do about it? The question's back to you. You might say, I'd just ignore it. I'd keep investing by the dip, diamond hands, right? But the data always shows the exact opposite. Retail investors might say that they can hold strong, but they often do the exact opposite. You never really know how you react until you actually have to make that decision. So here's the first solution to the problem with starting investing now. How do you decide when to do it? The question is, do you just throw it in now, or do you invest it over a regular period of time? Well, there's some good research on this, so let me quickly show you the breakdown. Vanguard looked at this exact question a few years ago, and it's a study they called Dollar Cost Averaging Just Means Taking Risks Later. They looked across the stock market from 1926 to 2011 and asked the question if it's better to throw all your money in at once or averaging, also known as dollar cost averaging. Across the UK market, the US market, and the Australian market, although the timescales weren't exactly the same, the outcome was pretty conclusive. Over 10-year rolling periods, you'd be better off around 67% of the time just putting it all in at once, rather than say over a period of 12 months. So let's say about 2/3 of the time you should just go ahead and not think about it. However, you still might be thinking, well, hang on, what about the other third? That's not good. You don't want to lose money. The thing is, there is a way to still make money even during a big U-shaped dip in the stock market that might take a decade to recover, and that's a combination of two different strategies. Now, technically, if you do get paid every month and you choose to invest like that, technically it's lump summing because all of the money you have, you're actually investing. However, by buying regularly, lots of people would still call that dollar cost averaging. Now, regardless of what you want to call it and fight about the naming, if you bought regularly between the example earlier, between say 2007 and 2013, you'd be in a really strong position because you would have bought all the way down and all the way back up again, and every one of your buys would have been lower than the price that you would have ended up getting to. The big issue you would have had to first defeat is your emotions. If you can set up your investing so it's just like paying your phone bill every month, you'll put yourself in a very, very strong position. Going back to that Vanguard study quickly, let me show you a couple of things they highlight in the conclusion which I think can help us on our next point. First, they say, and I quote, "Historically, a long-term upward trend has persisted for both equities and bonds, probably attributable to positive risk premia in the markets. In other words, positive returns have compensated investors for taking risks, hence the upward trend in those markets and the resulting probabilities of success for lump sum investing. So, to the extent that an investor believes the positive risk premia are likely to exist in the future, lump sum investing would remain the preferred method for investing an immediately available large sum of money." Okay, so that all makes sense. Investing is risky because there's no guarantees, but risks have paid off, and most of the time the market is moving up, and that's the power of the economy at work and all of the companies that make it up. However, check out this second part that I think really is the final point on this one. But if the investor is primarily concerned with reducing short-term downside risk and the potential for regret, then dollar cost averaging may be a better alternative. So bottom line on this one, it's better to just keep lump summing, but the question really is a personal one. Find out how you'd feel and then just find a strategy that works for you. Okay, so now that's been dealt with and you might feel a bit better, why should you start investing today or this week, specifically if things are not looking great out there? Well, just as the Vanguard study mentioned earlier, the stock market does progress upwards most of the time. It's why during most years or any given month, the market tends to be more valuable than it was the same period before. The thing is, that all sounds good, but unless you understand why that is, then it just makes no sense and it just sounds like you're investing purely based on hope. Remember that investing in the stock market is investing into real companies and businesses that generate real returns, actual cash and real value. Every time you go shopping for food, buy fuel, get some new clothes, you're spending money in the economy, and somewhere along the line, shareholders are benefiting from that growth. If you've already ordered the newest iPhone, then you're one of the millions of customers that Apple relies on to grow its business. It's a much more valuable business now than it was 10 years ago, which is why companies like Apple have gone from being valued at around $250 billion to $2.5 trillion. Now, whether or not Apple can do the same over the next 10 years is up for anyone to guess, but if you would start investing now into a broad, low-cost index fund that tracks the whole market, what's the chances of you doing well overall? Well, the answer is that the longer you invest, the more chance you give yourself of making a positive returns, even if you have the worst possible timing. And I know that some of you out there, just like me, always have that nagging devil on one shoulder saying, you're going to be the 1% to lose all their money. Just ignore him. He's always been annoying. Looking at the data on this, here's what history's told us about why long-term investing is one of the most powerful ways to increase our chances of making money. Looking back from 1871 to March of 2020, here's how your chances of losing money in any given rolling time period looks as you invest for longer periods of time. As you can see, if you're a really short-term investor and you give up after a month, you've technically still got just over 60% chance of making money, but it's pretty close to a coin flip. As soon as you start moving further out, even from just moving a couple of years, you really start to tilt the odds in your favour massively. Take any average period of 3 years, that says that over 75% of the time you'd be a positive return during all of those crazy time periods of more than a century's worth of data. I know you're still thinking, what if I'm in the 22% of losers? Well, don't judge things just yet. Again, the longer you invest, the better outcomes you get. And as you can see, if you can stomach a long investing career across your life and push past 10 years and all the way to 20, you actually end up at a position where only 0.1% of cases found themselves in the red. but that really is in the absolute worst case scenario. Oh, and this is with inflation taken into consideration too. So is that pretty much conclusive then? That if you hadn't started investing, that you should do it now or even as soon as possible? Well, my opinion for what it's worth will almost always be yes. So long as you're in a financial position with a solid emergency fund, you've paid off your high interest debts, and you've got everything else lined up, then the earlier you start, the better. Let's not also forget that with the tools and the platforms that you have out there available to you now, it's cheaper and easier than ever before to get started. If you want to trade regularly, you no longer have to pay high commissions or hefty fees for mutual funds. You can use low-cost ETFs and free to almost no-fee brokers. If you do want to get started with any of the platforms that I use regularly, then feel free to check out all of the links in the description below. I always have the latest offers and some free shares or cash to help get you started. You know, everything could still go south from here and we could still crash a lot further. Anything can happen and you can easily go and find some bad news. But that bad news isn't going to all of a sudden stop so you can get started investing. Remember, there's no need to build up investing as a single one big event. It's a long-term regular thing that should just be as easy as brushing your teeth. You won't know if you've ever timed the bottom of the market or when you've just bought at the worst possible time. But all that matters is that you find what works for you and you stick with it. If you want to follow along with any of my investing, don't forget to check out my latest portfolio update here from Vanguard and see all of my Investing for Beginners playlists here on my channel for a complete guide to getting started. Believe me, it's not as complicated as it looks. Anyway, thanks so much for watching, and as always, happy investing.